Well, time now for a look at the day's business news, and it's a big day, actually. I'm joined here in the studio by Brian Quinn from France 24's Business Desk. We're talking about the merger of two huge Swiss banks today.
Gavin, big news indeed. UBS publishing an open letter this morning announcing that its takeover of Credit Suisse is now complete. Of course, back in March, the Swiss banking giant acquired its smaller rival in a shotgun merger brokered by the Swiss government. The deal came as Credit Suisse was teetering on the edge of collapse. The merger promises to be complicated with thousands of jobs at risk due to duplication. Nick Rushworth reports.
UBS says it is the start of a new historic chapter in Swiss banking. The merger of Switzerland's two biggest banks, now completed between UBS and Credit Suisse, results in a giant of Swiss finance. The coming months are likely to be bumpy, says UBS Group CEO Sergio Ermotti, particularly regarding jobs.
We have to restructure to secure the future for all the other employees who will be part of the future. It is still painful, but obviously we will get it under control.
It is believed thousands of jobs could be lost. UBS Credit Suisse has 120,000 staff worldwide, with job cuts announced. It oversees $5 trillion of assets. The takeover deal is a mega merger, one backed by the Swiss Central Bank and with Swiss government support. The merger now comes after Credit Suisse faced collapse 3 months ago when its share prices fell more than 30% during trading. That after 3 regional lenders in the United States folded. The Financial Times is reporting that UBS is setting red lines for Credit Suisse staff, including a ban on new clients from high-risk countries and on complex financial products. Among the concerns about the merger is whether the bank is too big for Switzerland. A parliamentary commission will look into just why Credit Suisse came to the brink of collapse.
Let's get a check on the day's trading action now. Asian indexes mixed on Monday as investors wait for key interest rate decisions from a number of central banks coming up this week. The Nikkei in Tokyo up around 0.5%, with the index sitting near a 3-decade high. The Kospi in Seoul down 0.5%. Hong Kong and Shanghai treading water as the yuan hits a 6-month low against the dollar. Here in Europe, markets opening higher with investors awaiting the European Central Bank's next policy move. Analysts expect the ECB to continue hiking interest rates by around 0.25% as they continue to try to bring down inflation. UBS and Credit Suisse shares both gaining today, of course, the last day of trading for Credit Suisse. The big question for investors, though, is the U.S. Federal Reserve this week as investors look for a pause in the bank's interest rate hikes. Earlier, France 24 spoke with Han Tan, chief market analyst at Exinity Group, about just that.
That's a pivotal decision by the Fed, and that's due on Wednesday. Now, markets are expecting the Fed to leave interest rates unchanged this week, with only just a 30% chance of a hike. Anything else would be a shocker. So if the Fed indeed signals that it's comfortable leaving interest rates where they're at, and that peak U.S. interest rates are indeed here, I think that could spell more immediate gains for the likes of stocks and gold.
Next, EU Commission President Ursula von der Leyen was in Tunis Sunday, along with the prime ministers of Italy and the Netherlands, seeking to convince Tunisian President Kais Saied to accept the terms of a $1.9 billion bailout from the International Monetary Fund. So far, Saied has resisted proposals to cut government subsidies and restructure money-losing state enterprises. The EU says it's prepared to lend Tunisia up to 900 million euros, along with 150 million in budget support this year to help prop up state finances as soon as it finalizes that IMF deal. Von der Leyen also floating a possible 150 million euro digital cable link to Europe and a 300 million euro renewable energy project. Here she is.
Tunisia is looking to harness its tremendous potential of renewable energy. And the European Union needs reliable energy suppliers of clean energy as we are electrifying our entire economy. Thus, we need to invest in our infrastructure so that Tunisia can export clean energy to Europe and produce the clean energy for the country itself.
And finally, for business, yet another succession drama comes to its conclusion. The Wall Street Journal reporting that billionaire financier George Soros is passing control of his businesses to his second youngest child, Alexander. The 92-year-old Soros' $25 billion empire includes his democracy and human rights advocacy nonprofit Open Society Foundations. Alex Soros, describing himself as more political than his father, he intends to use the OSF to further liberal political causes like abortion rights, voting rights, and gender equality, as well as to fight against America's far-right political drift and the possible comeback of Donald Trump. The decision passes over elder son Jonathan in the wake of what the WSJ calls a falling out and a change of heart. George Soros says 37-year-old Alex has, quote, earned it. 37 years old, $25 billion. He's earned it.
Nothing like paternal charity and kindness there, is there?
Indeed.